Good morning. This morning we're going to talk briefly about how the interest rate relates to the stock market and what we've seen in the past from interest rate increases, similar to what we're seeing as far as stock market changes. So let's get right into this. Okay, so here's a simple graph of the Dow Jones Industrial Average over a period of 1915 all the way to today. You see two macro trends. One is from 1980s to today. You see it generally going up with decreases. And if you compare that to the fund rates, you see the rate of interest generally going down with increases over that time. So there's a direct correlation between that. And the reason is because when the interest rate goes up, less money is available, and that money generally comes out of certain assets that money can come out of quickly. So real estate money can't come out very quickly because there's year contracts on things, there's 30-year mortgages, things like that. So it kind of gets stuck in there. But in the stock market and crypto, it can come out immediately, and as you can see, it has and go in immediately. And so let's look back at the interest rates here and say you look at interest rate either starting in 68 or let's start in 72 and go to 74. They went from 3% to 14% primary. That's 11% increase. That's huge. From the standpoint of the effects on any commercial property out there, that's going to make their underlying interest rate 4 times higher. So they're going to have to figure out how to get money to cover that difference. And if you look here at the stock market during 74, let's check this out. It'll give you some idea of where we are today. So let's look at this. Let's look at 66 to 70. So you got 5,100, and this was 8,600. So decrease about 75%. And you go, how does that correlate to interest rates? So 70s, you had this stock market crash here. 65, it started at about 8,900, and by 82, the Dow average was down to 2,400. So this is about a 75% or 70% decrease in the value of the stock market. And so that is 65 to 82. And let's look at the interest rates in that time period. So you're at 65, you're at 4%, up to 82, you've just peaked at 20%. So this interest rate change reduced stock values by 75%. Okay? Now, let's look at some other correlations here. This one, 68, 69, 8,100 down to 5,000. And let's compare that to today. So today, this is showing 37,000 down this much. So let's look at another graph real quick. So look at the VIG index fund, and we'll see that at the peak here, it's 171, and now it's at 140, which is what, 25, maybe a 20% decrease. Okay, so comparing 20% decrease to what is done in your lifetime, which is here, is these type of corrections, right? And this is what you've seen. But if you compare it back to, when interest rates were rising, you have some decreases up to 70%. And so really it hasn't even touched that decrease. Now if you go back to 29, they call it the crash. It went from 5,800, and it took 3 years to get down to like 920. This time from 65 down to 82 took 17 years to get down to the same point. And right now, we are simply in this quick cycle, which has been on the way down for 6 months. Okay, so that's, you have a 3-year one, you have a 17-year one, and they both look like they pretty much correlate to, this one definitely correlates to interest rate increases from here up to here. And so you've seen we've taken them down. So basically the bottom line is the stock market value is going to be determined by the interest rate. Your asset values are determined based on the underlying profit that it makes. And so if you need to make a 3% return and it's valued at $100, now you need to make a 6%, it's now valued at $50. Okay, that's how asset values work. And so that correlation is good to understand, because people in your generation, I mean younger generations, might think, oh, 20%, this is a great buying time. Well, if interest rates are going to keep going up, we could see a 70% decrease in the stock market. Now, but it all depends on whether interest rates, so they keep raising it up. So let's say they get up to 5%, and then they start bringing it back down. Well, then you're going to see a corresponding increase in the stock market values. And so it's good to have that longer term perspective in mind when you're talking about stock market values. Now, why are they raising interest rates? They're raising interest rates because of inflation. And I'll talk about that in another video. I'll talk to you all later, and like and subscribe down below. See you later. Bye.